Welcome to the NDIS Property Australia podcast. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Today's podcast is number 22. The topic is diversification. And we have a guest speaker here today, Rob Maxwell, who's on the episode 4 last time when we were down in Melbourne. And here we are today in Melbourne again for the Melbourne Disability Expo. We're here with Rob from Plan for Life Australia, who also is Homes One, I think. Yeah, Rob, you want to introduce yourself?
Correct. Please? Yes, thanks, Minh. Glad to be here. So I help obviously with the SDA side of
acquisitions,
the business, acquisitions, and also sales as well. But my background as well is as a financial advisor and capital raiser, so I've got a lot of understanding of the overall world markets and different investment options that people can look at and assess.
Yeah. And today's episode is all about diversification. So why would people invest in SDA? And I guess it begs the question, well, what is there to invest in at the moment in the world order before even considering property or even NDIS property? So, Rob, what's your feedback in today's world in 2022 with all that's happening geopolitically and cash and bonds and shares and property and gold and Bitcoin and all those things out there? What's the world looking like to you? And to what should people be aware of and watch out for at the moment in the world?
Yeah, well, there's a lot of uncertainty at the minute with the world economy, with pretty much all countries around the world, whether it's the United States, Europe, Japan, Australia. So uncertainty means that people are unsure what to do going forward. And the big issue is ever since the GFC in 2008, which people will most likely remember, in order to solve the issues around that, governments around the world for the last 14 years have had to print a lot of money and borrow a lot of money. And that hasn't stopped. That's continued every year for the last 14 years. And then with COVID coming in 2 years ago, which then also caused a lot of disruption in the world economies and the supply chains and everyday businesses, the governments have had to print even more money as handouts for their populations. So what's that is now resulting in is that inflation has come back for the first time in 40 years since the 1970s. And that everything is skyrocketing. All your listeners will know when they go down to the supermarket, everything's 10, 20, 30% dearer than it was 12 to 18 months ago. Petrol's gone through the roof.
By about 30,
20 or 30%. It's come down a bit in the last week or so, but that's gone up. Electricity bills, gas bills, housing costs, rental.
Yes.
To rent a property now in Australia, I was just reading the other day, it's actually gone up 15% minimum in the last year in rental. So that's a direct result of a combination of money printing and then, of course, throw on top what's happening in Europe in the Ukraine with Russia and the war, which is resulting in issues around the supply of oil and gas and also food going forward, fertilizers and grains. That area of the world is a major supplier of all of those commodities. So that's causing everything to skyrocket as well. So...
And why we're bringing this up to our listeners, Robbie, is because all those things with regards to those countries, macro and micro factors, being produce, gas, funding, that is all coming from a macroeconomic point of view. And investors are probably wondering, what's it got to do with me? And I guess, if you look at your superannuation fund, there's a Australian portfolio, an international portfolio, or a balanced portfolio, and a high growth portfolio. So you are indirectly investing in the world markets and the Australian economy through these businesses and these sectors anyway. So we're bringing this up because what is the alternative for investors in the current. Sorry, let me rephrase that. In the current climate, economically, from a domestic and international point of view, and this is where it relates back to the SDA NDS market. Later on, we'll cover again anyway. But this is why it's important for you as an investor to understand this, because our clients who are investors, they come to us and come to anyone else, accountants and lawyers and financial advisors. Where should I put my money? The bank isn't paying me much money as a 1% yield, right? The share market is cyclical and
it's going up and down because people are fearful at the minute.
And by the way, how is the ASX 200 at the moment?
It's around 7,400.
So how have people's portfolios and share portfolios gone the last 12 months?
In the last 12 months, probably 0 to 5%, but in the last 3 to 6 months, it's been negative.
Negative how much?
Probably 5 to 10%.
Yep, and that's just the Australian market.
Correct.
What's the international?
A little bit worse.
Yeah.
The United States is down 10%. The Nasdaq's down even more. If you remember the tech stocks like Zoom and everything that skyrocketed during COVID, they're all down 60, 70, 80% in the last 12 months. Tesla's down.
Yep.
The only ones that aren't are probably Microsoft is doing quite well, but most of the big companies are down. And the issue is people say, well, okay, I'll just leave my money in cash in the bank. But as you mentioned, you can only get 1% on your money in the bank. And the problem is it's actually devaluing every year at the minute by 10 to 15% with inflation. That's how much you're losing by leaving your money in the bank. So that's not really an option. So you have to put it into some sort of asset. And when inflation is high, the best and safest havens for putting your money are in hard assets. And what I mean by that is land traditionally is the best long-term investment because it's a physical good that's scarce. So hence property. Now the advantage the SDA has got over and above that is that it's paying that high income of anywhere from 7 to 10% per annum.
Yeah.
Which at the minute is you just can't get in traditional markets. You can't invest in bonds at the minute and get more than a couple of percent per annum because, as we mentioned, interest rates are going down and bond rates are going down because the government can't afford them to get out of control. So bonds isn't an option. Then you've got gold and, as we said, cryptocurrency. So land is definitely, out of all of those investments, the least risk.
Yes.
Purely because it's scarce, and it's even scarcer with SDA property. And even though we can't be sure what the property market's going to do, it could go down a little bit, but I personally think it's going to keep going up because you're getting that 8 to 10% income per year. You're being shielded with any potential downside, so it's as good as any. Speaking
of 8 to 10% net yield, I remember 15, 20 years ago, the average investor could go, well, I might invest in commercial property as well. At a 7, 8, 9% yield.
Correct.
Now, in today's market,
probably 5 or 6.
And because the underlying assets are the retail and commercial and industrial properties, and they're all affected by
COVID and
supply chains
and the world economy.
So going back
and the prices have still gone up.
Exactly.
So therefore, the income yields have gone down.
And with all those businesses and tenants who are struggling to pay the rent, the yields are not there.
Correct. So it's riskier as well.
Yes, for commercial and retail and industrial.
Because you're worrying about whether your tenant's actually going to be able to pay.
For the last 20 years, residential property would have been a 4 to 5% yield play, as in the past. But in today's market, we're looking at 2-3%.
In terms of income, after all the fees and costs.
3% as a benchmark minus cost is probably 2% net return.
Yeah, definitely in Melbourne and Sydney.
Yep.
Regional, probably a bit higher. Yes. It's still up around 4%.
Yes.
But 2% on your money. So you are relying on capital growth in order to get ahead.
So, Rob, what's your opinion about SDA and diversification? Is SDA for everyone? And if not, when? And if so, when? And how does it play with the word diversification? Given all these assets out there, Bitcoin, gold, commercial, residential, shares and cash, what's your opinion about SDA as a asset class?
Well, it's got the underlying property, which owns the underlying land that is scarce. So that's always a good thing. If you've got time, remember, this all comes down to time. If you're talking a minimum 5-year to 10-year investment time horizon, then you can't do much better than investing in a property that is attached to SDA where you also get the income down the track. So I would say it's a very good option for a fair proportion of your portfolio for sure, getting the 8 to 10% per annum. And then if you, particularly compared to bonds.
How so?
Well, bonds, as we mentioned, are only paying probably 2%, theoretically low risk, but then you're getting a very low return. And because of all the money printing that's gone on over the last 10 years by governments around the world, even though we've got inflation and at the minute interest rates are creeping up a little bit, there's a school of thought that they're not going to go up as nearly as much as people anticipate, because governments around the world are so in debt, they can't afford to pay the interest rate, so therefore they've got to keep the interest rate down artificially, which is what governments for the last 30 years have done. Look at Japan. Interest rates in Japan have been almost zero for the last 30 years because of all the debt. And this is now happening in America, and it's also now happening in Australia as well. So traditional investments that a financial advisor would have recommended to their clients in the past would have been a majority of money in for a retiree, for instance, or for someone older, would have been to have a conservative portfolio mainly in cash, bonds, and a little bit of shares. That portfolio is not going to cut it going forward for the next 10 or 20 years. You need to find more income producing hard asset investments.
So 15, 20 years ago, a lot of the retirees or semi-retirees were aware of those annuities, pension income streams from the fund managers.
Yeah, and they were getting 10% per annum.
As a diversified
portfolio
conservative
with low
portfolio.
risk.
Yep. And that is no longer sustainable.
No. Well, now they're probably getting 3%, 3 to 4%.
On their super fund pensions.
Correct. And that 3 or 4% is actually devalued every year compared to what money's doing. It's losing 10 to 15% of its value.
So what are their options if a limited income stream that might be eligible for the age pension as well, maybe, depending on their, what's the word? Asset, what's the terminology? With the Centrelink,
It's just their value of their assets.
They look at your assets, which are, what's the word? Do you know what the word?
Oh, it's been a while since
Gotcha. Where they look at your home you live in, plus your investments, plus your cash, plus your super fund, see if you're eligible even for the age pension. Yeah. So there'll be a lot of people out there struggling to survive on the higher cost of living for fuel and food, as you talked about, and a lower income stream from their superannuation returns, investments, all right?
So they need a cash flow positive investment that's going to take the stress of any loans they've got.
Yeah.
And at the same time provide a long-term capital growth play, which the property does.
So, Rob, if SDA property is a 10 to 12% gross yield and it ends up being an 8 to 10% net yield, for the next 20 years it's got CPI in there, and CPI is a 2 to 3% target range, right?
Yep.
If you add a CPI of 3% to that kind of net yield, what's the long-term 10, 15-year outcome from today from that income? It's 8 to 10% net yield today. Then what will it be in 15 years from now? 10 years from now with CPI?
Well, I think with the way governments operate, and Australia is no different to the United States, they're probably going to keep the CPI rate around that 3 to 4% per annum, even if it isn't really that.
Yes.
Because they actually change the parameters of what they include in the basket to dictate what the CPI is. So the actual rental income will probably go up by an average of 3 to 4% every year for the next 10 or 15 years, which over that time frame means that in 15 years' time, it'll be double, roughly, what it is now.
So therefore, a $800,000 property, which is giving 10% net yield today, 10%, which is
will be up to 15 to 20% in 20 years' time, based on the purchase price.
Yes. So an 80 grand income really becomes 160 grand income.
Correct.
Yes. Okay. And because the SDA income is so strong, being 100 grand ish, give or take 20 grand, that 3-4% is quite big.
Yes.
4% on 100 is $4 grand a year increase.
It's gold, literally, the income from this particular investment. You just cannot get anywhere else.
And then on top of that, the NDIA, they revise the numbers every year as well. On top of that.
Correct. And then the rental guarantees and all of that will go up by CPI at the very least as well.
Yes. Yes. So, Rob, in your opinion, there's two categories here. Who should invest in SDA and who shouldn't invest in SDA? What's your opinion?
Anyone who's looking for a positive cash flow income versus traditional property should definitely look at SDA investment.
Yes.
Anyone who's got a time investment horizon of 3 to 5 years plus should definitely look at SDA investment because that reduces the risk. You could even do it as an early retiree, as an income play alternative to having your money in shares, bonds, and cash. So it's really applicable to just about everybody as a proportion of their portfolio.
Also, another answer I want to add to that list is if property investors who already have a number of property, who are all negatively geared.
Yep. Good way to even that up, and also no land tax,
yes,
as we know.
Yes.
And also potentially it improves their situation with borrowing with their bank.
Yes. So we've recently found out that SDA as an asset or property does not have land tax applicable to them. So if you are an investor who has multiple houses or properties in Australia, and we came across someone recently who has 20 houses to his name and 20 houses to his wife's name, the land tax that he was paying just didn't cover the income he was getting for rent, did not cover the land tax on the whole portfolio. So the financial advisor who was talking to him is talking to him about considering converting some of these properties as knockdown rebuilds to be SDA, and that asset being the houses that are NDS applicable would not have any land tax at all. Meanwhile, getting a strong cash flow of 10 to 12% return per year. Very much a good strategy right there, Rob.
Yeah, it's a very attractive option for him.
So as an investor, you got to take into account land tax issues, funding, lending, location as well, and the type of product as well. So I guess that's where we want to leave today's discussion about diversification. SDA is not for everyone, but not for the faint-hearted. But it's definitely a good asset class to consider, an asset which is coming into its own right as an asset class in Australia, right? Compared to industrial property, residential property, retail, and commercial. We're going to see more and more fund managers and sophisticated investors and retail mum and dads investing into the SDA market over the coming few years. So that's all we have to cover, Rob. Any last words of advice for anyone looking at gold, Bitcoin, and shares and cash and SDA, Rob? Any suggestions? Any final words?
Just make sure you do your research and be comfortable with what your decisions from an investment point of view are. And maybe look to diversify amongst a few of those categories just to reduce your risk. Even Bitcoin? Definitely.
Okay. So you heard it there, everyone. Pearls of wisdom from Rob. Bitcoin's the way to go. Thank you very much. We'll have a good night, and we'll get on to our next podcast about other things. Thank you very much. Bye-bye.
Bye.
We hope you enjoyed this episode. Please make sure that you are subscribed and following us so that you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this episode with those that can benefit. Until next time, catch you on the next episode.